So today I thought I'd talk about HELOCs. And the reason this is, thanks to Paul Saavedra, one of my clients, he called me and said, I will be paying this thing forever. And I said, well, not really. So I explained to him how his current HELOC works, and he decided to refinance it and wrap it into with his first mortgage since he'd used the money. And it dawned on me, and I thanked him. I said, I'm going to be sharing a lesson because it dawned on me that people don't necessarily know how HELOCs work and what's the difference between a HELOC and a HELOAN and a second mortgage. So I thought I'd go over that today because it's really important as people either are refinancing that they know, what they're getting rid of or what the benefit is of doing that. But also a lot of people are going out and getting fresh HELOCs. So it's good to know what you're getting into. Okay, so HELOC stands for Home Equity Line of Credit, and it can be a first mortgage or a second mortgage. Just like if you were to pay off your first mortgage and just wanted access to your equity just in case, then it's not a second mortgage, although you might have taken it out secondly. It's first in line because there's no other lien on your property. So in that case, it's a first mortgage. But typically you have a mortgage and then you go get another mortgage. So you would call it a second mortgage. So this is kind of like a lot of things in life. HELOCs can be second mortgages, but second mortgages are not necessarily HELOCs, right? So when people say second mortgage, they usually mean a fixed rate loan. And so the HELOANs can be for a particular time frame, 30 years, 20 years, 15 years. The HELOCs also are for a certain time period, usually 30 years, but they have an extra step included called a draw period, which I'll explain in a little bit. So what is a HELOC? So a HELOC is a line of credit, like a credit card, that's recorded or that they take the collateral of your home or your rental property as the collateral for that loan. So there's also lines of credit that they call signature loans. Just on your signature, they'll give you a line of credit. Many of you probably have those like at your credit union or something like that. It's just not quite a credit card. It's more like a loan, but it's more like a credit card. But it's a signature loan and there's no collateral given for that loan. So a HELOC, a home equity line of credit, is a line of credit against your equity, and there's limitations to that, but basically they're using your home or your rental property, the asset, as collateral. So you're also given a certain credit limit, just like a credit card. So HELOCs are a lot like credit cards. In fact, they are consumer debt, not mortgage debt. They fall under the consumer laws. So HELOCs, some terms that you need to know is HELOCs are variable rate mortgages or adjustable rate mortgages, and they're based on an index. So all variable mortgages are based on an index. Mostly HELOCs are based on the Wall Street Journal prime. So it's not the prime that the government lends out at, it's the Wall Street Journal prime. So for example, the Fed funds rate might be 0.25%. So then the Wall Street Journal prime is 3.25%. It's usually 3% above what the government is lending to banks. Okay, so you would take your index plus your margin, and that gives you the interest rate. And as the prime rate or whatever index the mortgage is based on varies, then your interest rate varies. So let's just like the prime rate went down pretty much my whole career. The prime rate's been going, shoot, So the prime rate now is very low. It's 0.25%. And so now is a good time to be borrowing this kind of money. But as inflation heats up, the Federal Reserve, who controls this Fed funds rate people call it mistakenly prime rate, but it's the Fed funds rate. So our prime rate's based on this. And as the economy gets going and inflation kicks in, they will raise the prime rate as a way to control the cost of living going up too fast, too soon, right? So right now, they've indicated, the Federal Reserve again has indicated that they probably won't raise the prime rate, but who knows? So your interest rate on your HELOC is going to go by the prime rate, which means it can go up. The margins, so the profit, I always think of it like profit margin to the bank, is the amount that the banks add on top of the money they get. So if they get it at 0.25%, they lend it to you at 3.25%, 4.25%, 5.25%. So that extra they add on top is called the margin. And all of this would be in your formal documents, your agreement on the loan. So So that margin depends on how much equity you have. Do you live there? Don't live there? If it's a rental property, it's higher risk. They'll add more. So the margin could be anywhere from 0, meaning they'll lend you at prime, or it could be 3, 4, 5%. So that's another area that you have to look at, because as the prime rate goes up, if the prime rate one day is 5%, your rate could be 8% or 9%. So the interest rate is not the prime. It's whatever the prime or the index plus the margin. Okay, so more terms that you need to know are that there's a floor and a ceiling. Okay, so the floor is the lowest rate that it could be, and the ceiling is the highest rate. So all variable mortgages or adjustable rate mortgages have this. So your floor usually is the rate you started at or the prime rate that you started at. So if there's a margin of 2%, let's say, then your lowest is going to be that lowest that you started with. So let's just say 3.25% is your lowest. Now the ceiling, okay, and they call these caps. So your low end cap is called the floor. Your high end cap on the interest rate is the ceiling. Some HELOCs have no ceiling at all, which is very scary. So if the prime rate one day goes up to 20%, that would be where you'd head on up there. But mostly what we see is 18% as the cap. So the ceiling, or the highest it could ever go, is 18%, which is high. That's not very reassuring or comforting that you can go to 18%, but they set that ceiling or limit. Okay, and the other thing that's good to know, there's no yearly limit as to how high or low it can go. So let's say interest rates start going up really high. 1 month your rate could be 5%, the next month it could be 7% if we saw such a jump. And I remember like in the 2000s, we did see a few times where they raised the prime rate 0.5%, and the next month it was 0.5% again. They were trying to slow down interest rates from the cost of living from going up. And back then it was the dot-coms, lots of money flooded the market. And so yeah, we saw inflation then. So anyway, so there's no yearly limit. So your payment can fluctuate kind of a lot. When rates were going down, it was great because the interest rate would go down month over month. So that was fun to see your payment go down. But some people didn't go down because their floor was so high, right? So if your floor when you started your loan is 5% and the prime rate like now is all the way down to where it is, you'd be stuck at that 5%. Okay, another thing to know is HELOCs usually have teaser rates in the beginning. So a bank might offer you prime only. They might even say prime minus 0.5 for the first 6 months, and then you go to the real rate, the index plus margin. So at some point when you've actually maxed out the line of credit, hopefully these are in a row. I should number these. So at some point when you've maxed out your line of credit, you owe the max, you're maybe going to want to think about converting it to a fixed rate, because now you're not going to be going up and down maybe. So some of these notes are convertible, meaning you can switch from the adjustable portion to a fixed rate. Usually they add 2% on top of wherever you're at. And they say, okay, this is your fixed rate. Now you're amortizing the loan, or you're paying it down every single month, right? Okay, so HELOCs also, just like credit cards, have a minimum payment. So the minimum payment is usually interest only, okay? And it's usually based on the amount you owe. So let's say you have a line of credit for $100,000. You don't pay interest only on $100,000 unless you owe $100,000. So you'll pay on the, let's say, $10,000 or $20,000, whatever you owe. They calculate that, although most lenders have a minimum payment of $100 because they still have to process the payments, right? So anyway, so the minimum payment is going to be interest only, and it's based on the number of days in the month, just like your credit card. So I've had people call me often. This is like a common thing that happens. They have a new HELOC. They've never had a HELOC before. They really don't pay attention to their credit cards and how those work. So let's say in February, their payment was $300. And then in March, they get an increase to $340. They're like, hey, what happened? The interest rates haven't gone up. Why did my payment go up? Well, it's because HELOCs are like credit cards. They're consumer debt. So you only owe the interest for the amount of days in the month. So your February payment is 28 days or 29 if it's a leap year, and then March is 31. So yeah, 3 more days of interest can be a whopper if you don't realize that that's happening. So just as an example, let's say you owe 100,000 and your index plus margin adds up to 5%, then your monthly payment in February is 28 days at $13.88 per day, gives you $388.88. So $388.88. But then March has 31 days, so you take the same $13.88 per day times 31, and you should come up with $430 per month as a minimum payment. So, like I said, some people go into a panic thinking their payment increased because of interest rates. They're not sure what happened. So that's what's happening is it's consumer debt. So they're calculating on the number of days in the month. So what if your rate goes up? So now if you're at 7%, your daily interest is $19.44 times 28 days is $5.44 per month or for that month. And then March is 31 days, it would increase to $6.02. So you can see where it can kind of rock the boat a little bit if you're not expecting that and you're wondering, how did this happen? So then if either one of these was principal and interest, this is kind of a good thing to see because people think that the principal and interest payment should be way more, but really if it's calculated over 30 years, it's not. So your 5% principal and interest payment would be $536. And then your principal and interest payment at 7% would be $665. So, a couple $100 more per month to do principal. Then another thing to note is HELOCs typically are calculated, the interest is calculated on a 360-day banker's year as opposed to 365 or 366 days. So if you're trying to calculate it yourself, look at your contract with the lender, but typically they're using a 360-day month to do their daily interest. Okay, so this brings us to our next term, which is the draw period. Pretty much it's what it says. You're going to draw money off your line of credit. You can pay it back. You can draw, pay it back. You can go back and forth, back and forth. Typically, this period is for 10 years. After the 10 years are done, then it's time to repay. So this brings me back to my friend Paul, who thought he'd be paying interest only for the rest of his life. And I said, wouldn't that be nice, actually? But no, they want their money back, and it's still a 30-year period. So now, after your draw period of 10 years is over, they're going to amortize. They're going to send you a love letter saying, dear so-and-so, I would like to get my money back, and here's how I'm going to get it back. So they're going to give you a calculation based on a 20-year amortization and get you to start repaying. What most people do is go out and get a brand new line of credit because usually rates are lower. And so they get a brand new draw period with the new lender that gave them the new HELOC, right? So keep that in mind. Okay. So what they do is after that 10 years, you can't draw and pay back. After those 10 years, they freeze the amount. So whatever you owe at that time, and this is kind of a warning because people don't know this and they miss their chance to get the rest of the money off the line of credit. So maybe you owe $80,000 and your credit limit's $100,000. That credit limit is available until the end of the draw period. After that, it's frozen. It's like cut off. So what you want to do is if you're close to that, draw the rest of the money so that you've got the money, unless you don't need the money, but most people still need the money to do other things. Take that money out, put it in the bank, and that way, when the draw period ends, that balance is what they're going to amortize. So whatever you owe at the time is what they're going to amortize. Okay. So now we go to the credit limit or the amount that you can borrow. So on a single family home that you live in, normally you can get up to 80% of the value of the home. So here's an example. If the home is worth $500,000 and you get 80% of that, that's $400,000. And let's say you owe, $250,000 on that home, then that means the difference between $400 and $250 is the equity you can get out. That's how much they would give you. So they don't give you the $400,000 because you already owe a mortgage on the property. So if the property is free and clear, then obviously they could give you the $400,000. So today banks are 75 to 80% of the value of the home. That's what they would give you. And again, you don't have to draw the whole thing. You're just locking in access to your credit, right? To your equity. When you're purchasing a home, you can get a HELOC up to 90% of the value of the home. Some people call that piggyback lending or 80-10-10s. So you put 10% down, we give you a regular loan for 80% of the value of the home and then another 10% for the difference. And that helps you avoid PMI. That's why people do that, but also because people want to build up equity quickly. So there's something to be said for having two debts and saying, okay, I'm going to hurry up and pay this one down a lot, right? And build equity so that eventually you only have the first mortgage left over. So that's a really good tool or technique when you're buying a home and don't want to pay PMI. And then on rental properties, typically they're lending 65 to 70% of the value of the home. So, and that's just because rental properties, I disagree, but rental properties are a riskier asset to lend on, especially in second position or behind a big mortgage. So, because if you don't pay the HELOC to protect their interest, the bank has to pay. And let's say your first mortgage is not being paid either. They're going to have to pay the first mortgage to foreclose so that they can secure their money. Because most likely, if you're not paying, there's a reason. And when the market is down, properties don't have equity. So these second loans are higher risk, and that's why they carry higher interest rates. Okay, so that's all good news. You know, if you have a rental property, you can access the equity. That's pretty cool. Some bad news is that because it's like a credit card, and I don't know if you guys have gotten these letters recently, because of COVID, we're seeing more of this. We saw these kinds of letters back in like 2008, 2009. Banks are arbitrarily, with no decision based on you personally, like your credit or your income or anything, they are freezing lines of credit because they see this as risk. They don't want this liability out there that a bunch of people could say, hey, I want my equity, or I want to take 100,000 out or whatever. So whenever the market's down, unfortunately, the very time people need the money is when the banks freeze the line of credit. So they can freeze the line of credit, meaning stop the draws, or they can reduce the line of credit. Let's say you have access, let's say your original line of credit was 250,000. They can reduce it down to whatever level they want and call it based on market conditions, right? So you want to be aware of that. That's another reason maybe to take the money out if you're seeing unstable markets or things like this. That's what I would recommend. Get the money off your home equity line, because you can always give it back, right? There's no penalty for giving it back. So just like credit cards, they can freeze it, they can reduce it. Typically, though, the trigger events is if you don't pay on time, they can freeze it or reduce it. If your credit score goes down, let's say you get a bunch of debt with other people and your credit score goes down, they have access to your credit scores forevermore. So they can see that your credit score went down and freeze your line of credit, because if your credit score went down, they're worried that there's other things going on in your life and you won't be able to pay them. So as a precaution, they'll freeze your line of credit. Let's see what else. That's pretty well. And if the market goes down, so in 2008, 2009, when property values were going down, a bunch of banks reduced. Whoops, let's let James in here. A bunch of banks reduced the the lines of credit on just across the board. Send out hundreds of letters reducing people's lines of credit. So, okay. And now next is the fees on HELOCs. So the fees on HELOCs are, usually they don't charge you upfront fees on HELOCs, but they do have fees. So they have to order a limited title policy, which is about $100, an AVM, which is an electronic appraisal, which is $75, credit report of $30. So there's some fees there. And what they do is they say they're not going to charge you upfront, but if you want to close out your line of credit before 3 years are up, they will charge you a early closure fee, or some people might call that prepayment penalty fee. So if you are close to the 3 years, I would recommend you just wait out the 3 years and then pay it off, unless you're selling property or whatever. That could be a problem. But basically the closure fees are anywhere between $150 to $500, somewhere in there, depending on the bank. The other fee that's involved in HELOCs is there's a yearly fee, kind of like if you have one of these signature credit cards or high-end credit cards, there's like a membership fee. So typical HELOCs will charge $75 per year as their membership or maintenance fee, sometimes they call it. And obviously, if you want to wire funds from your line of credit for any large purchase, they will charge you for wire fees and statement fees. And, they're usually in the contract, it lists out all the fees, so you can check that out. But those are the typical ones that I want to share with you. So the biggest thing that I see with HELOCs that people are unaware of that can be very dangerous is that so HELOCs are like credit cards. So when they report it to your credit report, it will say that you have a revolving account. It does not say mortgage. So mortgages are good debt because they're amortized, they're coming down, they're a big debt you pay on time. So on your credit report, this shows up as revolving or REV. So if you look at your own credit report, you'll probably see that. And the problem with that is that, from the credit module in Cash Flow Academy, is that if you're above 35% of the credit limit on any revolving account, you lose 10 to 20 points. And if you're above that, it could be even more. So you could be losing points on your credit score by having a HELOC, and most people don't know that or aren't aware of that. So that's something to keep in mind. So if you have a $100,000 line of credit, and you owe more than $35,000, you're losing points on your credit score. Then also, because you're not paying it in full, right? You're maintaining this debt, of course, that also counts against you in your credit score. So think closely. Think closely about whether you want a HELOC. If you have 800 credit scores, it doesn't matter, right? If you go down to 780, that's still good. But if you're marginal, if you're like at, let's just say you're at 700. If you go below 680, money gets very expensive, right? So just be careful and aware of that. So you know that this looks to the credit bureaus like you have a huge credit card that you've maxed out and that you're only paying minimums on. So keep that in mind. That's my biggest caveat actually about HELOCs, besides the interest rate having no limit with some banks. Okay, so just to wrap it up, HELOCs have pros and cons. They're a great tool for us as investors and homeowners. The pros are you can use it whenever you need it. The low monthly payments obviously is really great. The flexibility of the draw period. You may or may not be able to write it off. I used all my examples as $100,000 in debt because as of right now, that's the maximum you can write off on interest on your tax return, unless it's an investment property, then all interest is deductible, but on your own home. So I used $100,000 just because that's a good marker and a reminder for you. So the pros are you could also deduct the interest as opposed to using a regular credit card, right? Having it as a lien against the property is much better. The cons, though, so HELOCs have great pros. Oh, and then I didn't add in, I love that HELOCs is a debt against the property, which is kind of like pseudo asset protection, because when they search properties and they see that the property's leveraged, they may shy away. It's kind of like bug repellent, right? It's kind of to make people go away quickly. So, anyway, so that's another pro on the HELOCs. So the con side is that it's a variable or adjustable rate. It's subject to the lender's changes, whereas if you got a fixed rate, if you took the lump sum on a HE loan, if you just took that lump sum, they can't take it away. It's a loan. They gave you the money, and good luck to them collecting it and good luck to you paying it, but it's a loan, not a HELOC is subject to changes. Another con is the ongoing fees, and then also the possible effect on your credit score. So buyer beware. HELOCs are great. They can be great, but just like any debt, make sure you know how you're using the debt and that it's a healthy use of the debt. Okay, so that's it. That was kind of a long lesson. I apologize, but I think that's important information.